Okay, good day, good day. Today is November 6th, and I'm just going back over some charts for the last couple of days, 15-minute charts to make some observations about our Fibonacci trading. And I wanted to point out um, how oftentimes this happened actually yesterday. The candle that was the big candle that I was using as my basis for my bias and my basis for my Fibonacci retracement levels was very large, and we actually didn't get the retracement on the very next 15-minute candle. We got it two candles later. That happened yesterday when I bought um, a long at about 10:45 on the 10:45 candle. The 10:15 candle. I bought it about 10:22 a.m. The candle itself was formed between 9:45 a.m. and 10 o'clock a.m. So it was a big, strong elephant candle, a huge green candle. I think it was about a 75 or 100 point candle. Can't quite remember, but it was huge. And the next candle did not come down halfway. It came down, but it only came down about a quarter of the distance. And then the other quarter happened on the next 15-minute candle, the retracement to the 50% total uh, retracement, and that's where it bounced hard and came right back up, and we got that trade. So I guess the point I'm trying to make is that you're not always going to get the retracement on the next candle, or the other way it works is you might get a retracement on the next candle, and then you might get another retracement 2, 3, 4, or 5 candles later, if that's a really big basis for your trading. So keep those levels up, I guess is my point, and look for price to retrace, 30, 45 minutes later sometimes back to the levels that you created based on your big candle. So I'm just saying it's not something that you want to just erase right away if the very next 15-minute candle doesn't retrace back to it. Give you an example. On November 4th, 11:45, we were in a downtrend. The downtrend had started with this big candle here, and we did put a box on it, and it did retrace 50%, and it was a good trade. So that was the first huge red candle that did retrace 50%, as you can see right here. And price did retrace back to the 50% level, and there was a trade there. So that was the first one. Then, if you keep your eyes peeled here, you can see another big elephant candle. Not much of a wick on it, up or down. Not much of a top wick, not much of a bottom wick, just straight selling. At the end of this candle, when this candle completed at 12:15 p.m., you then had, at that point, a fast cross on your MACD line under your signal line, and you also had MACD line under the zero. So both of those are extremely bearish signals. So you know that your continuation down is probably a pretty good possibility. So at that point, what you could do is you could take your Fibonacci retracement tool and you could measure that candle for the basis of a potential trade. Now this one, as you can see, if you look carefully, you can see that this wick did wick up right to the top of the pivot zone, and that was a trade that was able to be taken right there. And if you look very carefully at this, and if you extend this over to the right a little bit, you'll see that two candles later, the 12:45 candle, it wicked up to the 50% line to the tick, basically, right there. So I guess my point, and if you want to get a close-up of this one, let's take a quick look. Just want to show you what it looks like in a fast chart, 12:45. Yeah, there it is right there. Let me actually add this to the other chart. Okay, there it is. All right, so the other confluences on this particular trade were that this is a 15-minute money line, meaning it's a 7 through 9 EMA on a 15-minute basis. So it had three things going for it: the 26 level, which is very often serious support or resistance. It hit the 50% level of that Fibonacci retracement to the tick, and it also hit the bottom of this money line here. That's this 15-minute money line, which is a cloud of between 7 to 9 EMA. So it hit three things there. So when you have that kind of confluence, hitting a 50% retracement to the tick of a big, huge elephant bear candle, and the 26 level and the bottom edge of a 15-minute money line, I mean, you've got a good trade on your hands there. And so that one, it went down a lot, as you can see. Right away, you were in the money. It went down, 50 points with zero hesitation, and then, bounced around under these money lines, went down another 50 points. So for a total of about 100 points on that one, before you had really any significant retracement. Those are the kinds of trades that, the risk, the reward on those things is much better than if you're scalping out, a few points here and there, because, if you're scalping out a few points, you're still taking the same risk. But if your strategy is not ironclad, if you don't have the kind of all the confluences that we had here, if you don't have a bigger picture perspective on the market to see where it's going and how it's going and where the real, I guess, arbitrage opportunities are, meaning that the price is way out of whack with where it should be. Basically the way to make money in trading, I've noticed, is that you're selling or buying price when it shouldn't be where it is. When there's some sort of counter trend move that you've got people that are not really thinking clearly, and they're trying to buy this up thinking they're getting a good deal. Just because the market's selling down so much doesn't mean it's going to break all its resistances overhead. They're still there. These moving averages are still there. These 50% retracement levels are still there off these big bear candles. Your typical levels are still there, like your 77s, your 26s, etc. And when they converge, these are going to be great places to rejoin the downtrend. So, when you're in a downtrend and you've got a 5-minute money line and a 15-minute money line heading down at 45-degree angles, you shouldn't even be considering buying. You should be looking to see where you can short the rallies, and don't even think about buying these kinds of EMAs. Sell these things, sell these rallies when you see them rally up into those areas. So keep that in mind, because you'll trade a lot safer with a lot better reward to risk. So I just want to say that. I just want to point out one more last time, reiterate the purpose of this video is that when you see that you're in a downtrend, when you see a big heavy candle like this, you definitely want to put the measurements on it and look for retracements to those that pivot box. If you don't get something you like the first time, for example, this one worked out. This first one right here, this green doji, it worked out okay. It was a little choppy. It didn't really go that far. It was really choppy in here. But, as you can see, half an hour later, it worked out really well, okay? And it went down really well. So I guess what I'm trying to say is that levels are there. They don't just disappear once you use them one time, especially if they're really good candles that created them. And so leave them on your chart and look to see if price will get back up there one more time, because the second time might be the real time that it really goes. Okay, that's all I want to say for now.